Chapter 3. In this chapter, we will discuss how financial services firms are organized, discuss the structure, talk about essentially the medium, small, and large institutions that exist, and why have larger institutions become larger over time. We will also discuss and define what is the bank holding company as well as the financial holding company in this chapter. So in chapter 1, we discussed what banks are, what are their assets, liabilities. Similarly, we discussed assets and liabilities of insurance companies as well as investment banks. We discussed in general what is the role of financial services firms. Here we will expand upon that role and also discuss the structure, size, and the different types of financial services firms that dominate the industry today. We find the fact that when we look at banks, commercial banks, the three largest in the United States are Citigroup, JP Morgan Chase, and Bank of America. Collectively, they hold $6 trillion of assets. That's roughly 25% of all bank assets are owned by three large banks. There are 7,000 banks essentially in the US. When we look at the relative percentage of assets held by small, medium, and large size banks as of 2009, you can clearly see the disparity. The largest banks hold roughly 90% of all bank assets. However, the smallest of the banks hold a little bit more than 1% of the total assets, while medium-sized banks hold a little over 9% of the assets. Remember that assets are essentially loans banks give out as well as investments in securities, primarily government securities. To show the relative significance of the largest institutions, let's take a look at how many large institutions are there. Remember, they hold almost 90% of all banks' assets. We find the fact that the largest institutions, little over 500 large commercial banks, which represents only 7.5% of roughly 6,800 banks that operated in the United States as of 2009, although that number has not changed much since then. These 7.5% of the banks hold 90% of the assets. 37% roughly of all banks out of 6,839 banks, roughly 2,500 banks are considered small. These banks hold only 1% of all bank assets. And the medium-sized banks are roughly 3,800 medium-sized banks, 55% of all banks in the US. They hold 9.4% of all bank assets. Do expect multiple choice questions in the exam related to the statistics that we just discussed. Let's discuss here, let's talk about why have large institutions become larger. You've probably heard of the term too big to fail, and that is truly what has happened to some of the institutions as they have grown in their market share, which is, by the way, measured by assets, total assets, which, as you know, 90% of the assets are held by large banks. If you look at 2005, the darker line is the largest banks. Medium-sized banks are dark gray, and the lighter gray is small. And you can see the disparity. If you look at the change over the last 25 years or so, we find the fact that the difference between the assets held on an aggregate basis by large banks compared to small and mid-sized banks was not much. They were pretty close to the same. Large banks held about 42% of the assets, medium-sized banks held about 35%, and smaller banks held about 22% of the assets. Today, the large banks hold significantly higher percentage of the assets. So we've seen a dramatic increase in large banks' market share. At the same time, we have seen a decrease in the market share or total assets held by small and mid-sized banks. What we notice here, by the way, is that the mid-sized banks, which is the darker gray, are the ones that have seen the biggest drop in the market value of their assets, compared to the smaller banks that have also experienced a drop as well. At their expense, the larger banks have grown. What we'll do is we will discuss here about 4 or 5 different points and explain why this has happened, essentially. There have been a number of changes that have occurred that have reshaped financial services firms, banks, and other financial institutions over time. One of the reasons why larger firms have grown is because of the fact that they have the money, they have the capital, they have the equity available to invest in technology. As you well know, financial services have become more technology oriented. We now use debit cards compared to using cash when we want to buy anything. Technology has changed because we now have internet banking. You can do your banking using a smartphone. You don't have to have a computer, or you don't even have to go to a bank branch any longer. So technology has played a big role in the products and services and how they offer the services and how they have grown the products and services as well. It's the larger institutions that have benefited because they have the funds available compared to small and mid-sized institutions. The other reason why larger institutions, larger banks and institutions have grown even larger is because they have acquired, they have merged, they have purchased small and mid-sized institutions as the smaller and mid-sized institutions fell. So their market share continues to go up. But the primary reason why larger institutions have grown over the last 25 years is because of regulations. As I mentioned to you before in chapter number 1, up until 2008 financial crisis, all governments across the world were allowing financial services firms to offer whatever products and services they wanted to offer, gave them a lot of liberty to do whatever they want to do. And therefore, because of regulations, they were allowed to grow as a result of that. Since 2008, governments have become much more stricter in the regulations. So let's take a look at the regulations that have changed or resulted in the market share of these larger banks growing. We will look at first 1994. In 1994, a law was passed, and we will discuss this later in this chapter, whereby banks were allowed to expand and open branches all over the country, as well as internationally. Up until 1994, a bank such as Citibank could only have branches in New York State. Why? Because Citibank was headquartered in New York, and it is still headquartered in New York. But now Citibank has branches and operations throughout the country as well as throughout the world. Likewise, the same is true with Bank of America, JP Morgan Chase, HSBC Bank, M&T Bank, etc. So that law that was passed that allowed them to expand and offer and open up branches and operations internationally and across the country, the law is called Interstate Banking Law. Interstate Banking Law allowed them to open branches in other states as well. Therefore, essentially, as large banks began to expand in all different states, the smaller and mid-sized banks could not compete with them, since they opened up the branches right next door to them and they took away their customers. And therefore, small and large banks had no choice but to sell themselves off to the large bank because they could not compete. As a result of that, we find the fact that over time, from 1994, the actual impact was about 3 years later. It took about 3 years for the larger banks to put the small and medium-sized banks out of business in certain parts of the country. And you find that the larger banks continue to increase their market share at the expense of the small and mid-sized institutions who experience a drop in the market share. There were not everyone was pleased with that. There were individuals in certain states, United States, especially in the farm states of Wisconsin, Minnesota, in the Midwest. Many of the individuals were not happy with the fact that we had a Bank of America opening up branches in these small towns. They were quite happy with the small bank there because these small banks would use the deposits and give loans back to the farmers. So the money was being reinvested in those same communities. When large banks came in, such as Citigroup, Chase, Bank of America, etc., they took the deposits from these small communities and they invested those deposits and gave out loans to large companies in New York City, Los Angeles, all across the country, and all over the world. So those funds were being diluted out of the community. That was one of the disadvantages of having these large banks open up branches in smaller communities. The other disadvantage was the fact that it reduced competition. When there are less firms offering the same products and services, the price of the products and services will go up because of less competition, and that's exactly what happened. Let's take a look at the next point, 1999. In 1999, another law was passed. Now the fact that all these large institutions from 1994 to 1999 had opened up their operations all over the world. In 1999, the governments allowed these institutions, remember the fact that they were providing them with much more freedom to do whatever they want to do, reducing the regulations. And in 1999, a Bank Modernization Act was passed. We'll discuss that further later on in this chapter. The 1999 Bank Modernization Act allowed all banks to offer other than banking products. So it was beginning in 1999 that a commercial bank, such as Bank of America, can now offer investment banking, insurance products, mutual funds, hedge funds. That is in 1999 when an investment bank such as Merrill Lynch or Morgan Stanley or Goldman Sachs could offer bank deposits and give out bank loans as well. And insurance companies such as MetLife, New York Life, AIG insurance companies, all of these insurance companies can now offer banking products as well as investment banking products. So essentially, it allowed all these financial services firms to offer each other's products beginning 1999 as a result of the Bank Modernization Act. This Bank Modernization Act allowed these large institutions who had a lot more capital than small and mid-sized institutions to offer these products and services. They could hire the people, they had the technology to be able to offer the products, they had the expertise, and they could pay the individual money to be able to offer these products. Small, mid-sized firms could not do the same thing. However, we find that beginning with 2002, 2003, 2004, and 2005, we begin to see an increase in market share again for these large institutions, which happened back in 1995, 6, and 7 as well. And then for a while, there was stability in the market share. And then suddenly, because of the 1999 Act, the market share went up. However, this time, there was a difference. The market share for these large banks and financial services firms increased, not necessarily at the expense of the small and mid-sized firms. You notice the fact that the market share of these firms did go down slightly, small and mid-sized, but they did not change much. In fact, small banks' market share pretty much remained the same. Small, larger, mid-sized banks' market share went down a little bit, not as it did back in 1999, rather in 1994, 95, 96. The reason why larger banks and larger financial firms increased their market share is because they acquired other banks, other insurance companies, as well as investment banks, not the small commercial banks or the mid-sized commercial banks. It was after 1999 that Citigroup became the Citigroup. Prior to 1999, Citi was a Citibank. It was not a Citigroup. Today, it is Citigroup Financial Services because they offer all products and services. It was after 1999 that Citibank purchased the largest insurance company called Travelers Insurance. Citibank purchased the sixth largest investment bank called Smith Barney Investment Bank. So Citibank wanted to be the largest financial services firm across the world. They wanted to offer all products to all individuals, and therefore they began to buy out investment banks and insurance companies as fast as they could. As a result of that, their market share continued to go up. The same thing happened with JP Morgan Chase, Bank of America, HSBC Bank, M&T Bank, Key Bank. All of these large banks began to offer and purchase, or either offer these products internally or purchase other non-banking firms such as insurance companies and investment banks and mutual funds. So this time the market share went up mainly because of acquisition of non-banks compared to banks that had happened back in the mid-1990s. Well, what does it look like now? In 2008, although the author does not show us what the trend is between 2005 and 2015, I'd like to explain to you what the trend looks like. As of 2008, we had a financial crisis. It was the larger institutions, because of the fact that they'd gotten involved with all these different products and services, they're the ones that fell the most. And the financial crisis did not affect the small and mid-sized banks. So therefore, the larger banks lost some of their market share because of the losses that they incurred. Many of the investments they had made became worthless, and therefore investments are assets, and therefore their assets went down, in fact, in 2008 for the next 3 to 4 years. So in fact, it has stabilized now. As of 2008 up to 2011, their market share has actually gone down somewhat for the largest banks, although the market share did not go up at all for any of the other banks. As of 2013 to 2015, these large banks have now begun to increase their market share again, but not at the same pace as it had increased in 1996, 97, 98, 99, or as much as that increase in 2003, 4, and 5. So now we are starting to see a slight increase in market share. Let's talk about community banks. So instead of larger banks, community banks are small banks. They tend to provide good service to customers. They know customers by their names rather than by account numbers, and therefore community banks have actually done very well, competing by taking some of the customers who prefer service rather than what large banks are offering as far as products are concerned. Some of the big corporations and the wealthy individuals prefer large banks because they offer diversified products. Some of the other customers prefer community banks because they provide personal service. Community banks' organization chart is rather simple. They have a much more they have less products and services, of course, so their organization structure is not complex. We'll compare this against the larger banks. Larger banks are money center banks. What we mean by that is that they are located, their headquartered are in large money center cities. They also are known as wholesale and retail bank. Wholesale means they provide products and services to companies. Retail means they provide services to individuals. Their organization structure is a lot more complex, mainly because they offer a much more broader products and services. And they are much more diversified across the country as well as across the world. Again, we talked a little bit about the trends, what has reshaped the financial firms. Of course, technology is one of the reasons why they have grown dramatically. In the last 10, 15 years, a lot of these large financial institutions had set up call centers in other countries such as China, India, Brazil, Philippines, and so forth. These call centers answer phone calls from customers. So when you call an 800 number, if you have any questions that you need to ask your bank, somebody from one of these countries is actually answering the call. Let's now talk about the more major categories of banks and other financial services companies. We will first define what are insured banks, what is the difference between state chartered and national banks, and what do we mean by member banks. First, the insured banks. Insured banks means the fact that, not that because they are insured, what that means is that the banks will insure up to $250,000 of your deposits. And what that means is the fact that if that particular bank fails, the Federal Deposit Insurance Corporation, FDIC, which insures these deposits, and the banks pay a fee for that, of course, the FDIC government agency will provide the deposits back to you up to $250,000. So as a customer depositing up to $250,000, your deposits are safe. That's what we call by insured banks. We'll look at some of the statistics of how many banks are insured by FDIC on the next page. What is the difference between state chartered versus national banks? State chartered banks are those banks that only are allowed to have branches in the state that they are organized. For example, New York State. They will not have any branches outside of the state. These are typically small and mid-sized banks that are considered state chartered banks. All large banks are national banks. National banks operate across the country as well as across the world. Again, remember, as of 1999, the Bank Modernization Act allowed banks to offer products and services. As of 1994, the Interstate Banking Act allowed a lot of these national banks to operate nationally. That's when the difference occurred between the state chartered and the national banks. More on this on the next page. Member banks. Member banks are members of the central bank. In the United States, we have the Federal Reserve. In China, is the People's Bank of China. In Europe, is the European Central Bank. In London, Great Britain, is called the Bank of England. In Japan, is called the Bank of Japan. Every country has a central bank. These large banks are members of the central bank. All national banks are members of the central bank, and many of the state charter banks are also members of the central bank. There are some benefits to being a member, and of course you need to pay for the membership by buying stocks in that particular bank, in the central bank. One of the benefits of a member bank is the fact that banks can borrow money from other banks if they are members of the central bank. Many times banks find themselves not having sufficient liquidity, sufficient deposits to support loans and investments. This happens often because customers deposit money and they withdraw money up until the branch is closed. Therefore, banks cannot control how much deposits they will have when the branch is closed at 4 p.m. each business day. So they find themselves not having sufficient deposits. Governments do not mind banks not having enough deposits because they can borrow from other banks, and these are called federal fund loans. We'll discuss these more in chapter number 6. Banks are allowed to borrow these funds only for overnight purposes. What that means is that the loans will expire the next day. So they need to pay back those banks the money that they borrowed today by tomorrow. They can borrow again tomorrow, but these are always one-day loans. These are some of the statistics. We'll spend a few minutes on this particular page. As of 2009, all of the 6,839 banks that we have, or we had in the United States at that point. Let's take a look at some of the statistics with regard to these banks. What percentage of these banks are insured by the Federal Deposit Insurance Agency? What percentage of these banks are state chartered versus national banks? We just define those. What percentage of these banks are member banks and not members of the central bank? And what percentage of these banks have deposit market share in the United States as well? Now, there has not been a significant change since 2009 with these statistics. They have changed just fractionally, but not a great deal at all. So these particular trends that we see, some of the statistical information, are shown in pairs of two. So for example, this is one statistics, the first two. The next two is another statistics, and so forth. So we have five different statistics that we will discuss. Please keep in mind, you do expect a couple of multiple choice questions on these statistics. You will not be asked to memorize the exact percentages that you see that in brackets here, but you should know the range of the percentage. So, of the roughly 7,000 banks, 98% of all banks are insured. Banks' deposits are insured by the Federal Deposit Insurance Corporation, FDIC, a government agency. The remaining 2% of the banks, about 140 banks, purchased insurance from other insurance companies such as GEICO. There is a subsidiary of GEICO that provides bank insurance. Banks can purchase insurance from private insurance companies. They do not necessarily have to purchase insurance from the government. But 98% of the banks purchase insurance from the government because the government insurance provides a certain amount of credibility to the bank. From a customer standpoint, if you feel that your deposits are insured by the government, FDIC, Federal Deposit Insurance Corporation, you will feel much more comfortable and safer to deposit your money in that bank compared to the one that has purchased insurance from a private insurance company. So all banks are required by law to insure up to $250,000 deposits, except 98% of them by purchase insurance from the government. Let's look at the next statistics. Of the total Federal Deposit Insurance Corporation banks, so of the 98% of the banks, so these statistics show the 98% of the banks. That's why the total is 21 plus 77, that's 98. They don't add up to 100 because this statistics does not include the 140 banks. 21% of the banks that are insured by the FDIC have national chartered. So 1,448 banks operate across the country in the United States, and 5,360 banks only operate within the state that they were headquartered, which is 77%. Again, if you're asked a question in the exam, you don't need to memorize exactly 77%, but you should know that it is somewhere between 75 and 80%, and this is between 20 and 25%. So range is sufficient for you to know rather than the specific percentage. Again, 77% of the banks operate only in the state, while 1,448 banks, such as 21%, operate nationally. Again, of the 98% or 6,839 banks that purchase insurance from Federal Deposit Insurance Corporation, how many of these banks are members of the central bank? Again, central bank in the United States is the Federal Reserve, and we spoke about some of the benefits of being a member, but you need to purchase stock in that bank, central bank, to be able to become a member. All large national banks are also members of the central bank. So for example, we have 2,228 banks out of the 6,839 banks that are members of the Federal Reserve System, which is the central bank in the United States. However, national banks only represent 21% of the banks. So the 21, this 32% includes the 21, plus the remaining banks are from state charter banks. So all national banks and some of the state charter banks make up the 2,228 banks that are members of the central bank. The state charter banks that are member banks are those that are some of the larger mid-sized banks, not the small or the lower end of the mid-size, but the upper end of the mid-sized banks, as well as all national banks. Let's take a look at the next. This particular statistics discusses what market share of bank deposits that you and I keep in the bank, as well as companies and corporations and government agencies that deposit money in the bank. We find the fact that 39% of all bank deposits are held by state charter banks. What percentage of the banks are state charter banks? 77%, or 5,360 banks, are state chartered. However, they only have 39% of the deposit market share, mainly because they are the smaller banks. On the other hand, 21% of the banks that are national chartered banks, or 1,448 banks, have the remaining 61% of the bank deposits. So again, almost 2/3 of the bank deposits, or 60% of the bank deposits, are held by about 1/5 of the banks, 1/5, about 20-21% of the banks. While the remaining 39% of the deposits are held by almost 3/4 of the bank, or 77%. Finally, we're going to discuss the banks that are member banks and what percentage of the deposits, the same deposits that we talked about here, bank deposits, that we split them up between 39 and 61%, state chartered and national chartered, we find that 75% of these deposits, all of the deposits, are held by banks that are member banks of the central bank. So let's take a look at how many member banks are there. So if you go up here, we find that 2,228 banks, or 32% of the banks, are members of the central bank. And that particular statistic ties to the 75%. So 32% of the banks hold 75% of the deposits. These are 32% of the member banks. The remaining banks that are not members, 65% of the banks, or 4,520 banks, have only 25% of the deposits market share. The reason why these member banks have such a large deposit market share is mainly because of the fact, one reason is because they also operate nationally. So all national banks are within this 75%, and all member banks are also within the 75%. So the two advantages that they have is, one, that they operate nationally and they can get deposits from customers all over the country as well as all over the world, and also the fact that they are members of the central bank as well. While these other banks are state chartered, they're not members of the central banks, and therefore they hold only 1/4 of the market share, or 25% deposit market share. So do expect some multiple choice questions. I could combine two of these statistics into one question. So for example, I could ask you the question as follows. 21% of the national banks, the percentage of the banks that are national banks, 21%, they have what percentage of the deposits? Your answer should be 60 to 65% of the deposits. So I could combine two statistics into one. Or I can ask the question, 77% of the banks are state charter banks. What percentage of the deposits do they hold? Well, they hold only 39% of the deposits. So I could combine this statistic with that, and this statistic with this. Okay, let's discuss some differentiation between unit banks and branch banks. Unit banks are those banks that only operate out of one branch. Therefore, they are state chartered. Today, we only have a handful of banks in this country that are considered as unit bank organizations. Most of the unit banks have been acquired and purchased by larger banks because they have failed, mainly because they operate from only one branch and they have not been able to compete. However, branch banking means the fact that they have large number of branches across the state or across the country. What this page shows is that number of bank branches, total bank branches, held that are opened by different banks across the United States have changed. Between 1980 and 2010, when we look at the last 30 years, the number of new branches opened have always been higher than the number of branches closed. And if you look at each one of these years, we find that this number is higher than this number. In 1994, we had the state, we had a law passed called the State Interstate Banking Law. In 1994, banks were allowed to open branches across the country. And if you look at the number of branches opened, there was a significant increase in number of branches opened, almost 1,000 more branches opened in 1994 than 1993. The reason for that is because a lot of the large banks began to open branches in different part of the state. That continued in 1995 as well as 1996, and then it became much more stable. What we find is that after the 2008 financial crisis, when many of the larger banks failed rather than the small banks, we find the fact that the number of branches closed as of 2010 is greater than number of branches opened. This is the first time it has ever happened whereby the number of branches opened is less than branches closed. And some of that was because of the bank failures as well. Branch organization means the fact that each branch will be fully equipped. They're much larger branches. They can offer all products and services out of the branch. They have a drive-in whereby customers can drive in, as well as they have an ATM machine as well. Page number 19 is not required. This essentially shows a graphical presentation of a branch. Again, as of in 1994, just to show you some of the largest regulations passed. One of the largest regulations was passed in 1994, and it's called the Regal-Neal Interstate Banking Branch Efficiency Act. It was 1994 Act that allowed banks to expand across the country. Means they were allowed to open branches in all different states as well as internationally. We also find the growth of the branches in terms of total branches that they have. This particular slide that we looked at previously only showed the number of branches opened and closed. This page discusses the aggregate number of branches that exist. We find the fact that the number of main bank offices has declined. The number of branch offices has grown over time. It is not until 2010 that we find the fact that this is the first year there was a decline in the branches as well. Let's talk about the different ways in which we perform banking services. Traditionally, people used to go to the branch to do banking services, buy bank products. Today, a lot of those products, a lot of the services are offered online. We've got internet banking services. We have ATM machines. We have point-of-sale terminals, which are at the merchants. When you swipe your card to buy something, that is known as a point-of-sale. You are paying right at the point that you buy the product, and the merchant is being paid by you swiping your debit card. at the terminal. Call centers began to operate. One of the biggest change that has happened in the last 5 to 7 years in banking is what we call virtual banks. Virtual banks is the latest of the technology. What that means is that now you can do and perform all banking products on your smartphone. You don't have to be in an office. You don't have to have a laptop. You can be anywhere on campus and do your banking if you have a smartphone. And that is known as being able to do your banking virtually. Virtually means anywhere, at any time, 24 hours a day, 7 days a week. This page is not required. It shows more or less, again, the graphical presentation of how banks are, systems are interrelated. This is not a page that you are required to read. Let's talk about and define what is a holding company. We will talk about first holding companies, and then we will discuss financial holding companies. Holding companies are parent companies. They are called the shell. Under the holding companies, there are a number of subsidiaries that exist. Because of the regulations all over the world, a bank cannot offer insurance and investment banking services or products under the same subsidiary. They must set up separate subsidiaries under the holding company, the parent company, to sell different products and services. And the reason for that is because of the fact that investment banking and insurance products are more risky than banking products. Regulators do not want your deposits that you save in the bank for safety purposes to be used for investment or insurance services. By having different subsidiaries, that prevents banks from doing that. These are the largest bank holding companies, which are the parent companies. You notice the fact that these three largest bank holding companies, they used to be banks before 1999 when the Bank Modernization Act was passed. Now they're called holding companies, and they hold, if you combine these three total, that's almost $6 trillion of assets. 6 trillion are held by the three largest banks. We also have something called multinational banks. These are large international banks. They have expanded their operations across the world. These are the products and services that legally, that by government regulators allow financial services firms to legally offer. We will discuss this a little bit more at the end of the chapter. This is an example of subsidiaries that are set up. As of after 2009, this is the discussion about the 1994 interstate bank regulations, where banks were allowed to open branches across the world and across the country. In 1999, we discussed the Bank Modernization Act as well that was passed. As a result of the Bank Modernization Act, the term financial holding companies originated. What we mean by that is that I'm going to go back and show you. Until when 1990, prior to 1999, banks were known as bank holding companies. Once they were allowed to offer other than banking products, they were renamed financial holding companies. What that means is the fact that now they can offer various products and services. Larger institutions that had a lot more capital equity, They can pay experts in managing different products and services, etc., benefited from becoming the financial holding companies. Financial services holding companies, these used to be bank holding companies when they were only offering bank products. Now that they can offer different products, insurance, investment banking, they can also offer travel agencies, real estate development, as well as commercial banking. They are now renamed Financial Services Holding Company. These are the largest financial services holding companies in the world. You'll find banks, insurance companies, investment banks, and so forth. Let's move on and talk a little bit about the in terms of the efficiency. Are large banks more efficient than small banks? Well, to a certain extent. Efficiency is defined as an institution having economy of scale, or what is also known as economies of scope. What we find here in this graph is that the smaller banks that are on the left-hand side of the graph have a very high unit cost. So the cost per product and cost per unit is very high. As the banks become larger, their unit cost declines. They become more efficient. And then it stabilizes. At some point in time, when this institution becomes very large, over $25 billion, because they need to invest more money, their actual unit cost begins to rise again. So you see kind of a U-shaped curve. However, once they start to rise, it doesn't go as high as the smaller banks. Smaller banks have the highest unit cost compared to the mid-sized banks and compared to the larger banks who may have a slightly higher unit cost. Great. So now that we've finished chapter number 3, what I wanted to do is discuss and go through 2 problems at the end of chapter 3. We'll take a few minutes to review these 2 questions. These are stated on the syllabus as well. We will refer to the couple of slides in the textbook again to answer these questions. Problem number 1, these are non-quantitative problems. The question is, if you, assuming you are a financial journalist and you are writing an article for a US newspaper, you are asked to explain why large banks' market share has grown over the last 25-30 years compared to mid-sized banks and small banks. We looked at this. To answer this question, I'm going to go back to the slide that we looked at on page number 16, slide number 16. So the question is, or rather page number 15. Page number 8. So, but again, we referred to this particular slide when we went through the materials. The question is, what are the reasons why larger banks have increased market share compared to mid and small size banks? Here is the answer. We first discussed the 1994 Interstate Banking Act. The Interstate Banking Act allowed banks to open branches across the country as well as across the world. As they expanded across the country, they had ended up acquiring some of the smaller mid-sized banks. They did not fail, they just happened to be bought out because they could not compete with the large banks. and therefore their market share went up at the expense of the small and mid-sized banks. In 1999, the Bank Modernization Act was passed, allowing banks to offer non-banking products such as insurance, investment banking products, mutual funds, and hedge funds. In this case, the bank market share went up not because of the small and mid-sized banks, but because of the fact that some of the insurance companies and some of the investment banks, specifically the smaller insurance companies and investment banks, were acquired by the large commercial banks. Therefore, the market share went up as their assets went up as a result of that. In 2008, while we don't show that here, we actually experienced a decline in the market share of large banks, mainly because of the fact that the financial crisis resulted in some of the larger institutions' assets failing, not the banks, but their assets failing, and therefore some of their assets became worthless. Therefore, the market share of the assets declined as a result of that. It had no impact on the small or mid-sized banks. And in 2015, we found the fact that the market share has now stabilized. So that answers the question number 1. Be aware of the fact that you could be asked a multiple choice question whereby you should be able to explain for 1994, 1999, and 2008 and 2015 why market share changed. We will look at the second question that is also assigned. In this case, of the business activities listed below, and we have 12 different banking or business activities listed, which activities can be conducted legally through U.S. regulated holding companies today? So financial holding companies, as we spoke about, which actually emerged from the bank holding companies, banks, insurance companies, as well as investment banks, mutual funds. Which one of these 12 products and services are they allowed to offer according to U.S. regulations? To answer this question, we're going to go to the page number 27, and this is the page that we did not go through in detail because we were going to review the problem at the end of the question, at the end of the chapter. So I will read the actual service or product from the end of the chapter and show which one of these are listed here. If these products and services are listed here, means they are allowed to offer. If they are not, means legally they cannot offer the product. The first one that the author is asking is data processing companies. Yes, the financial holding companies are allowed to have their own IT departments. In fact, which is data processing. They can also offer data processing services to other smaller banks that do not have the IT departments because they're too small to be able to afford a data processing department of their own. So the answer is yes. B, office furniture sales. They are not allowed to offer office furnitures. They cannot compete with Staples or Office Max or Office Depot. Those products can only be offered by department stores, not by financial holding companies. C, auto and truck leasing. Could they lease an automobile or a truck to a customer? Yes, they can do that through the subsidiary called leasing companies. They can lease equipment, machinery, as well as automobiles and trucks. All financial holding companies can do that. whether it's an insurance company, investment bank, or a commercial bank. Although we found that most of the leasing business is limited to banks because they have been over time they have been the experts in the leasing business. General life insurance and property casualty insurance. Could they sell insurance? The answer is yes. These financial holding companies are allowed to offer insurance products. So they can act as insurance companies. They can compete directly with GEICO insurance for automobile as well as life and property insurance. Can they operate as a savings and loan association? Is E. Yes, they can operate as a savings bank as well as a commercial bank. This can all be done under one holding company. F, mortgage companies. They can offer mortgages. In fact, that is one of the largest products that they offer. Offer mortgages to homeowners as well as businesses. So the answer is yes. G, could they actually provide could they provide general insurance underwriting activities? What underwriting means that falls under the insurance company agency means they can sell and underwrite insurance policies. Underwriting insurance policies means the fact that they qualify you as a customer. So first they qualify. If they underwrite, that means they're qualifying that you are allowed to buy insurance, and then they sell the insurance product. So underwriting comes first, which is qualification, and then selling. They're allowed to do both. H, professional advertising services. This is one product that financial holding companies cannot offer. Holding companies cannot offer marketing or advertising firms, advertising products. Those are limited to marketing companies. So the answer is no. Underwriting of new common stock and issues by non-financial corporations. Could they underwrite stocks and bonds of stocks of corporations and bonds issued by corporations and government agencies? The answer is yes. This falls under the investment banking firms. They can underwrite stocks and bonds. Means the fact that they provide a service whereby they find buyers for the stocks and bonds on behalf of the government or the corporations. So the answer is yes.